The major factor is the oil price fluctuation. COSCO Shipping is highly sensitive to the oil price fluctuation, which we can tell from the recent stock price. It is just from July to September that a major plummet occurs to the stock price of COSCO Shipping. So if oil price goes up in the next few months, then the profitability of COSCO Shipping will be hurt. The second factor is the exchange rate. Because the major revenue of COSCO Shipping is settled in US dollars, so any changes, no matter the depreciation of US dollars or the appreciation of Chinese currency, will make the revenue of COSCO Shipping shrink. A third one is the global recession, whose influence is so profound that the shipping industry cannot avoid hurt. Also, the negative influence of the slowdown of the world economy that will post on the international trade will probably make the demand for shipping to drop and the profit of COSCO Shipping to decline. So to sum up, we have constructed a traditional portfolio by purchasing two stocks, WestJet Airlines and COSCO Shipping. This decision is based on our estimation of the one-year oil price and the S&P 500 index. And this portfolio, by our calculation, will have a holding period yield of 63.53%, which is quite high. Next, Paul will show how we construct a 130-30 portfolio by adding a sell short recommendation to even improve this already satisfying results.
So to start off with the short recommendation, our target stock is Peabody Corporation, which is in the coal industry. It's the largest company in the industry, and it's ranked #1 in revenue and #9 in return on investment, as well as operating margin. And it's ranked #9 out of 99 companies. So our target price is, if not 1 year from now, is 10.75. Currently, we believe that that Peabody Energy is overpriced at $34.09 on October 10th. However, there are still some risk factors that we need to consider. The first risk factor is, is it there? Okay, the first risk factor is the fact that increasing global demand for electricity might drive up the stock price of Peabody Corporation up. This is because Peabody produces approximately 10% of all US consumption for electricity and 2% worldwide. So an increase in global or local demand for electricity will drive the stock price up. The next risk factor is an increase in demand for coal in US. It is argued by some advocates that the most compatible option for the existing US vehicle fleet and fuel infrastructure is actually coal, because coal can be used to make gasoline. The last risk factor is the oil price fluctuations. Basically, okay, so with an increase in oil price, there will be more chance to substitute oil with some other products such as coal, which will drive the demand for coal up and increase the price of Peabody stock. And also other analysts argue that if the oil price drops below $50 a barrel, then this would decrease the exploration of oil and gas, therefore increase demand for substitutes such as coal. So either increase in price or drastic decrease in price of oil will probably drive the stock price of Peabody up. Now we'll talk about the portfolio returns, adding the short position. As you can see, the return is 102.54%, which is a lot higher than the 63.5% return we had with the traditional portfolio. Now we're going to talk about what happens to these portfolios, both the traditional and 130/30, if our estimates of the stock prices are down by 20%. For the traditional portfolio, we get 37.76%, which is still quite high. And for the 130/30 portfolio, we get 67.15%, which is almost twice as high as the traditional portfolio. On this graph, you can see that overall the 130/30 portfolio outperforms the traditional one in any case, the downside or the normal scenario. And now you will talk about other issues.
So to sum up, according to our previous analysis, we find that the 130/30 portfolio strategy is a straightforward extension of a long-only strategy, and by offering a controlled level of shorting. So by comparing the portfolio return of the traditional portfolio and the 130/30 portfolio, we can clearly see that the 130/30 portfolio offers a higher portfolio return and a better investment allocation. So we think that the 130/30 portfolio is a better portfolio strategy than the traditional portfolio, and it is promising and will be broadly accepted in the future. According to the report by JP Morgan, about 25% of the of the U.S. large cap core equity allocation will adopt this method in the next 3 to 5 years. So our conclusion is that the 130/30 portfolio strategy is better than the traditional one, and it is a good choice for portfolio management. That concludes our presentation. Thank you, Loiskin, for listening to our presentation.
We would now like to open the floor up to any questions.
What is the main disadvantage of the 130/30 portfolio strategy?
Okay, so a couple of disadvantages that might be encountered with this 130/30 portfolio is basically the risk, because the selection of individual stocks to be included in the portfolio still depends on the manager, so on his expertise. And also the management fees are higher for the 130/30 portfolio than they are for the traditional long-term portfolio.